Thanks for tuning in to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, starting with our chart of the week, this table here shows returns by sector in each quarter going back to 2023. Now, in the far right, we can see Q1 of this year, which was quite a bifurcated quarter. While six sectors, led by a big gain in energy, actually gained value, five sectors lost value. So this sort of dispersed market activity tends to happen during market corrections. Now, the bad news for the S&P 500 index is that the five sectors that were down account for about 75% of the market cap. Now, looking back at the past quarters that energy was the leader, we can see that growthy sectors like tech were down in those quarters. But the following quarter, in both those cases in this table that saw energy leadership, the following quarter, energy leadership faded and growth sectors performed well. We'll see if that's the case this time around. Now, one interesting trend with energy performing well in the first quarter is that the probability of a Fed rate cut fell and for a brief period actually swung to a positive probability of a Fed rate hike. Now, the market has been trading with these probabilities, as we can see on this chart here. Now, we think that the chance of a hike is still very low, while a cut could become more likely later this year. Now, this chart here shows S&P 500 performance in different Fed rate regimes. Note that the market has performed best when the Fed has been easing, but returns have been solid when the Fed has been neutral. Hikes have been met with sluggish returns. Now, falling rates have been a positive bull market influence in the last few years. Now, one of the reasons we think a cut is still more likely is the labor market. The official government jobs report last week showed a strong gain in jobs for March, but the February job loss was revised even lower. And for the impact on inflation, we want to watch the trend in wages. This chart shows that average hourly wages have been easing since 2022, and at 3.5% wage growth is around the lowest level of this cycle. Now, we can get commodity linked inflation pops, but sustained economy wide inflation would likely take a stronger labor market. Now, since the launch of ChatGPT in 2022, AI has been front page news. This year, AI has wreaked havoc on the software industry, as shown in this chart here. The fear is that AI can allow companies to bring software development in-house. Software is one example, but AI does have the potential of disrupting many service-oriented industries. Now, in a world of AI-driven abundance, investors may want to consider an allocation to scarcity, which could be real assets. So here we're showing that infrastructure and mining stocks have performed well this year. We're open to the possibility that real asset outperformance could be a long-term theme. Finally, touching on fundamentals, in the Q1 correction, valuations did come down. The trailing price to earnings ratio fell from about 28 to just a bit over 25, but that's still a fair bit above the average market valuation. Because of that, we don't see much room for markets to get more expensive. Rather, returns are likely to be driven by earnings growth. Now, analysts expect strong earnings growth in 2026, and the economic environment is solid for earnings right now. So this chart here shows an earnings growth model from Ned Davis Research, which takes several economic inputs to formulate its output. And currently, the message is that the environment is bullish for earnings growth. So to wrap things up, Q1 was a bifurcated quarter with particular leadership from energy. In the past two energy-led quarters, the trend reversed in the subsequent quarter. The market has been tracking along with Fed policy expectations. We think that market participants became overly hawkish and a cut is still more likely. That is largely because the labor market is not overheated right now. The AI trend is something we constantly monitor, and AI developments have created disruption in certain industries. Real assets are scarce, and we are open to the possibility that real assets could perform well for a long-term time horizon. Finally, in Q1, valuations came down but are still relatively high. Fortunately, earnings growth could be solid this year, helping to drive positive returns by year end. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.